Hello everybody. So in today's video, I want to go over the 10 top stocks in my portfolio and stocks/assets, because I'll conclude this video talking about Bitcoin, MicroStrategy, Bitcoin miners, and some other positions that I have in the crypto space. It's worth mentioning that for the longest time, Bitcoin was my second largest position, but it is now my biggest position because of the nearly exponential rise that we've seen in the price of Bitcoin in the past few months, and so it's the number one position now, Bitcoin. So I guess let me begin with Tesla. So Tesla is my second position. I am determined to making Tesla back into my first position, and the stock keeps dropping, so that doesn't help. I find Tesla very cheap right now at 500 billion in market cap for a company which if you remember, Elon Musk delivers. He delivers late. There's no denying that. He's been late on many things, but he usually delivers. And what he said is Tesla is going to be worth Saudi Aramco plus Apple together combined. It will be hard, but it will happen. So that would mean a $5 trillion Tesla. Well, if Tesla gets to 5 trillion, you're looking at a 10x. And if you think I'm delusional, keep in mind that I remember the days, right, 4.5 years ago now, probably next to 5 years, when people used to say, oh, it's impossible to have a $1 trillion company. And I remember Apple reaching the $1 trillion mark, and market pundits and classical, traditional legacy thinkers could not believe that Apple could be $1 trillion. That was not long ago. That was not 10 years ago. That was 5 years ago, when people could not believe we had a $1 trillion company. And today we have multiple $2 trillion companies. We have two $3 trillion companies. So when you hear things like Tesla could be worth 5 trillion some days, I absolutely don't think it's that far-fetched of a thing to think. Keep in mind, this is a company that has a mind-boggling amount of revenue at close to $100 billion in revenue. That's tremendous. The price to sales for a stock like Tesla is actually not that bad at a 5. It's not that bad at all. They're still predicted to grow 19%. Their cars are selling. Musk is doing everything to sell the cars. You may know that, for example, in the US, they're raising the price of a Model Y on April 1st. The Model Y is the most sold car in the world. They've beat the Corolla for a car that's roughly 3 times more expensive than the Corolla. And if you look at enterprise value over gross profit over revenue growth, which answers the question, how much am I paying for that growth? Well, Tesla looks like the most expensive stock. But to be fair, Tesla has always looked very expensive on that metric, or at least within the past 2 years, it looks expensive on that metrics. And the reason for that is because the revenue growth predicted by analysts is very negative, very down. A lot of people are saying they're not going to grow as much. Keep in mind the long-term guidance given by Musk to us was 50%. That was a long-term guidance. It seems like we're in a period of a slowdown because of interest rates. These are stocks, Tesla, Enphase. These stocks are driven mostly by interest rate narratives, and that's why it looks expensive. But keep in mind that if that growth rate went back to 50%, and if the gross margin went back up to their better days, when the gross margin were closer to the 25% range, you would have a much more attractive ratio here. EBITDA margin is high in my view at 16%. For the type of stocks I invest in, and I invest in stocks that are typically early on in their adoption, this is high. Tesla has roughly 5% market share in the automobile sector. Of all of the new cars sold, 5% of them are Tesla. That's outstanding. But if you look at market share in electric vehicles, in the US, for example, the EV market share of Tesla is still roughly 60%. So if EVs are going to be a thing, there's going to be one clear winner, and that will be Tesla. And we are seeing so many companies struggling right now. The competitors are not coming, right? Recently, Ford closed its second F-150 Lightning manufacturing line. They shut it down. Rivian postponed a new plant that we were going to build in Atlanta for their Model 2. They postponed that, and we don't know if it's ever going to get built. And Fisker, right, yet another company was supposed to compete against Tesla, is rumored to be filing for bankruptcy pretty soon. And that's why the stock was down 50% on Friday. So the competition's not coming. The market share is resilient, and Tesla is just the beginning of an EV company story. May I remind you that they are at the heart of the next AI revolution with embodied AI, robots. That's something that the market is entirely discounting, which is funny because the lion's share of the media goes to Figure.ai and to OpenAI. People forget that Tesla, as in my view, the only credible player in that field, the only credible robot in that field, which is Optimus. And this is not to say that Figure AI, that the robot is no good, or that a Boston Dynamics robot is no good. This is not to say that. This is to say that the only company that can pull off manufacturing of those, in my view, is Tesla, because you still have to pull off the manufacturing. Making a prototype is easy. Making a product to mass market and mass manufacturing is hard. And I'm very happy to be having Tesla as my second largest position. Now, my third largest position is actually Enphase. And Enphase is the solar industry, the solar panels. So what does Enphase do? Well, they do microinverters. Microinverters are these tiny boxes that you put behind each solar panel that you would have on your roof, and it turns your DC current into AC current. And I've made many videos on the channel as to why I believe this is the best technology. This is a much better technology than string inverters. String inverters are an appliance. They're an industrial technology. They require a lot of manual labor to be made. Microinverters are not. Microinverters are just printed on PCBs. They are very easy to manufacture. They're very easy to ramp. And they make a lot of sense from many technical standpoint. And also they are eligible to roughly almost twice the IRA benefit compared to string inverters, which is why Enphase is winning the inverter race, because they're getting the subsidies, they're able to scale quicker, they're lighter. Installers love them because they don't have to install these bulky appliances on the wall, i.e. string inverters. There's a lot of reason as to why Enphase, I believe, is winning in that space. And Enphase is predicted to grow very slowly over the next 12 months at 12%. And the reason for that, of course, is a high interest rate. Who wants to finance $30,000 at 10-11% today to finance a roof? Well, fewer and fewer people, but the demand for electricity over a very long run is still going to explode. We're going to need way more electricity. AI is going to be competing for that electricity. Bitcoin mining is going to be competing for that electricity, and therefore electricity, the cost will go up for households, and the more electricity goes up, the more it makes sense for people to get solar. Again, on my spreadsheet, this is a stock that looks expensive, but it only looks expensive because the growth rate is fairly disappointing right now. I'm happy to own Enphase for a very, very long run, and I don't care what it does within the next 12 months. And that the same is true for Tesla. The same is true for all of these positions. These are all positions that I want to own until past 2030, and ideally forever. For many of them, I would love to own forever. And if you own a stock forever, then you don't have to pay capital gains because you just own this stock forever, and you can borrow against it as the billionaires do, and that's the way to go. I believe that's the way to short the US dollar, which is kind of the initial theme of this channel. Beat the denominators, the whole idea that there needs to be some shorting of the USD happening. Anyways, that's a tangent. Not going to go there. Moving on to Crowdstrike. Now, Crowdstrike is realistically a very expensive company. It is the most expensive company that I own. At a 24 ratio of enterprise value of revenue, that's very expensive. But Crowdstrike is the leader in endpoint security and in cybersecurity terminals, cybersecurity software on device. They are the absolute leader. There's no denying. There is, to quote Michael Saylor, but for cybersecurity, there is no second best for CrowdStrike. A lot of companies are moving away, even from Microsoft in cybersecurity, to move to the endpoint security system of CrowdStrike. They are firing on all cylinders. They are doing outstanding, and the market agrees with me on that. Everybody agrees with me on that. This is a company that I was buying when there was way less expense. Would I buy CrowdStrike today? No, I would not. I would find this company way too expensive today, but I think I'm up like 170% on the stock or something like that from when I was buying and covering it on the channel. So not selling, but not buying more at these levels. They are the leader in cybersecurity, though. The numbers are great. The rule of 40, by the way, is not there. It's 34%. But these are companies that as soon as they turn on profitability, they will reach above 40% on the rule of 40. Mature companies in these spaces can achieve the rule of 40 even with no growth. And if you're familiar with the rule of 40, this comes from the SaaS sector, which is this whole idea that to invest in a stock, you should see 20% revenue growth, 20% EBITDA margin. That it should add up to 40. And so if you only have 10% revenue growth, that should be made up for in terms of EBITDA margin. That's the general rule of the 40. And it says that stocks that achieve that are actually good investments and worth a buy. Now, moving on to HIMS. HIMS is a company that I love, which is, this is yet one of these stocks where I'm annoyed because I'm more than 100% up on it. This is more than a double for me. I've been covering this stock for a while on the channel, maybe a year and a half now that I've been covering it. HIMS has a lot of things that are very similar to CrowdStrike in the sense that it's recurring revenue, just like SaaS, just like CrowdStrike. What is HIMS? HIMS is a digital doctor plus a digital pharmacy without insurance. They do not accept insurance. And because they do not accept insurance, they have transparency. They remove the anxiety associated with waiting for your bill in the mail after you visit the doctor or after you visit the pharmacy. You never really know what you're going to pay in the US healthcare system. With HIMS, you have transparent, upfront pricing right away, and they focus on, quote unquote, no big deal type of issues that people are likely to get early on in their life, in their 20s, in their 30s. Things like ED, things like hair loss, things like weight loss, all of these, lower stakes health conditions that can be treated on a recurring basis, on a chronic basis, and that require, prescription refills, and that's what HIMS does. So HIMS, for a monthly price, includes your doctor visit and your prescription refills by their own pharmacy, and it's an e-pharmacy with an e-doctor all in one, easy to understand. And I think this company has an ability to grow quite a bit from where they are right now. I mean, they have a total addressable market that could be as high as 100 times bigger as it is today. And they're also getting in the UK. They might be getting in other Anglo countries, and why not in European, mainland type countries soon. And that's something that I look forward to for this company as well. Company to own for the longer, in my view, absolute leader in their field. Another company in the healthcare space that I love very much is TransMedics. TransMedics, I've been accumulating heavily recently. TransMedics. This is a company that I first dismissed because organ donations, it's not an easy topic to think about. But nonetheless, they are revolutionizing the organ donor and the organ transplant world with their organ care system. What TransMedics has is they have organ care machines, where once an organ is removed by a surgeon from, unfortunately, someone who is deceased, that organ can be maintained in this system, which kind of looks like an artificial womb of some kind, and you can just have a heart in there, and the heart is maintained alive much longer than the old way of doing it, which is what people used to do, which is just putting it on dry ice. And they are FDA approved, and TMDX just acquired an airline as well, and so now they do transportation of organs as well as sell their organ care system offering, and it leads to outstanding outcomes, and they hope to achieve 10,000 transplants within a few years, and that's why the growth is predicted to, and that would be about 4x what they are today. So this company is predicted to grow tremendously from a huge base. They're still predicted to grow at 73% from now. And so if you take into account 73%, which the company only guided for 55% growth, only. It's crazy, this amount of growth in the current economics and the current interest rate environment. It's a blessing to find companies that are growing this fast. But if you add these numbers, you get a 0.23 on my enterprise value over gross profit or revenue growth. So that's cheap. That's first quartile. And of course, with that growth rate, even with only a 6% EBITDA margin, with that growth rate, you're getting a 79% on the Rule of 40. So almost a double the Rule of 40. Absolutely outstanding hyper growth company. This is as hyper growth as it gets. Then let me move on to Celsius Holdings. Celsius is, of course, if you live in the US, you're very familiar with that beverage. It is the beverage that is taking the US by storm. Go anywhere. I mean, any grocery store, Costco, convenience store, in the morning, in the evening, men, women, old, young. This beverage is just everywhere. It seems like everybody's drinking this beverage, at least where I'm at in Texas. It's quite crazy, and this is a beverage that is resonating with a lot of consumer, and I think a lot of the legacy competition like Monster Beverage must be in a world of hurt in the US right now, because everybody seems to be buying that beverage. Also, if you look at Celsius Holdings, there seems to be a lot of demand from people who are getting on these Wegovy/Mounjaro type drugs, the GLP-1 inhibitors. A lot of people are, and this is social culture, right? This is popular culture. In popular culture, there seems to be this trend on TikTok, etc., saying, well, if you do Wegovy with a Celsius Holdings beverage, Celsius improves your metabolism. You got to take care of your metabolism. I don't really know if the claim is true. In fact, we know that they've kind of backed away putting these claims from the conference call. If you listen to the Celsius conference call, nonetheless, this is the trendy beverage. This is the hip beverage, and they are milking it. They are making absolute great amount of money, 20% EBITDA margin, outstanding, right, for a beverage space. And the partnership with Pepsi is helping them sell out. And this is a company that's predicted to grow 56% next 12 months. So because of Celsius beverage, if you buy it at Costco, it's going to be roughly $1 a drink. If you buy it at the convenience store, it's going to be $1.98. These are expenses that people don't really think about, and they're almost disrupting coffee. I could see this. I could see a lot of people in the U.S. instead of having coffee, and in the U.S. typically people add a bunch of sugar and milk to coffee. Instead of doing that, I could see people just getting a Celsius. So very interesting takeover of the market. And again, go to any grocery store in the US and see those aisles and see them run out. So anyways, a stock that I've added back, and I've added it back because even though I do not believe my spreadsheet is appropriate for SoFi and for Nubank and for analyzing neobank, I've added it back because I feel bad talking about my 10 best assets and 10 best stocks in the portfolio and not talking about SoFi, because SoFi is a top position for me. SoFi is a company that some people are quick to dismiss because it's one of the very, very popular companies online, along with Tesla, I suppose. The one popular company online that I don't have is Palantir. Palantir, by the way, would be at a nosebleed valuation on this spreadsheet. Tesla actually looks very very cheap. SoFi looks a little more expensive here with these levels, and SoFi at a 0.91 looks a little more expensive. Sorry about that. No, turns out SoFi is middle of the road as far as valuation. I just noticed as I was recording this that I had revenue wrong. So this is the real revenue for SoFi. This is a little more than $2 billion of real revenue. So actually, SoFi is middle of the road when it comes to valuation. It's cheap when it comes to EV over revenue metric. That's cheap when it comes to that standpoint, and it's right in the middle as far as my EV over GP over revenue growth at a 0.49. It's right in the middle, but this is a company, SoFi, that right now is penalized by low growth expectations. Analysts are predicting only 22%, and they've guided that they wouldn't grow too much in 2024, and that is because they are planning to slow down on the lending, and they are protecting themselves from market risk right now, and so they're being very prudent with their lending. And keep in mind that banks grow as quickly as they want to lend, and so this is a company that's purposefully retrenching its lending, and as a result result of that, it is not looking as cheap as it once did in my spreadsheet. But when this company resumes lending and starts lending and making a bunch of money like that, they will look cheap again, unless, of course, the stock resets. So that was it for SoFi. So again, the right number is 2 billion. So if you got to this video in the earlier, that was the wrong number. And I'm just gonna leave the screenshot of the right valuation. Okay, let's move on to StoneCo. StoneCo next week, right? For earnings. I'm very excited for the earnings next week. StoneCo is a stock that I find very cheap now. I know in the comment section, many of you have told me, the growth is actually not the 45% or 41% that I had. And you find me different examples telling me analysts are predicting 11%, 9%. Again, when I go on Seeking Alpha, I don't see these examples. When I go on third-party websites, I see higher numbers. And when I look at their net income predictions that they have, their own predictions, and they guide on net income, they are guiding a much higher growth than that. So what I did is I lowered the growth expectation to 25% next 12 months growth. And that valuation with 25%, that would be the second cheapest stock in my spreadsheet. You know what? Even if I had 11 or 12% growth, this would be still a stock that would be twice as cheap as, say, a SoFi, for example, or a third cheaper than a MercadoLibre, or etc. I mean, it would still be a cheap stock if it was growing at 11 or 12%. So that's important to note. What's great for StoneCo, of course, is the EBITDA margin, excellent at 47%. I joke with STNE and I say that they are in the cash piling business. This is a stock that is the quote-unquote Square of Brazil. They have 3 million small businesses who use their payment terminals, and it's a stock that really fell with the SPAC quote unquote mania that some people call, and it never recovered. And I think this is one of these companies that has a potential to recover, and that I'm very happy to own. Now let's talk about my most steady Eddie, my most consensus stock that I have in this spreadsheet, which is MercadoLibre. MercadoLibre is the Amazon of Latin America. They are Amazon without the cloud, essentially, but other than that, they are very similar to Amazon. They have the leading website. They have the leading shipping system in Latin America, beginning with Brazil. Brazil is their biggest market. Mexico is their second biggest market. They've been successful at operating in Argentina. With a new leadership in Argentina, we'll see if this creates some upside for MercadoLibre. And it's a stock that is cheap, trading only at 5 times revenue. Look at their gross margin for that revenue is pretty darn high at 58% gross margin in e-commerce is very high, and that's of course on the take rate, right? They're still predicted to grow 27% over the next 12 months. E-commerce is still growing very fast in Latin America. And, they have the understanding of a local market more than a foreign player. And they are in the third cheapest group. They're the first tier cheapest. That's a 0.33. You're still first tier cheapest. This is a company that's EBITDA margin profitable. And so because of that, it achieves rule of 40 if you add 27 to 19, you get to a 46 rule of 40. MercadoLibre requires, in my view, very little time from me, very little time to analyze it. It is so steady Eddie and consistently undervalued right now. At least I find it undervalued for that type of business. I think it will see a valuation reset at some point as the interest rates inevitably drop. And let me conclude with my most controversial position. And that is Bitcoin. And I know it's controversial to talk about Bitcoin on a channel that has spent a lot of time talking about stocks, but of course I have to talk about Bitcoin. You may know, if you follow the channel, I've been into Bitcoin since 2015. Now, like many early day Bitcoiners, I made the mistake of selling all of my Bitcoin back then, and I sold it all at 250. And it teaches you great philosophy when you sell at 250 and you think you are real smart. I mean, there's a lot of examples, like people selling Netflix at $7 thinking they are really smart. I mean, there's a lot of examples, but that's why it's very tough for me to sell. Like it's really, really tough for market movements to shake me out of any asset that I have. Very tough today. It's like I hold and I hold forever. And that's why popular culture today, if you look at things like diamond hands and all of that Twitter culture, I think it's I think it's wise advice. I mean, no financial advice on this channel, but there's a lot of movement in the markets that are manipulated to shake out people who own stocks. To newbies, newcomers, retail owners. Sometimes they'll create big price movements to shake people out of stock and push people to sell. And in the early days when you start investing, I guess it's a mistake that you do to not think for yourself and sell your stock. But Bitcoin, this is not my first cycle. I'm fully used to the asset. I actually consider Bitcoin to be my safest asset out of all of these assets. I don't think there's any asset that is safer than Bitcoin. But of course, you would get this understanding on Bitcoin only after studying it for maybe 10,000 hours, and I'm well over that, obviously, since I've been into this space for 9 years now. I have full confidence in Bitcoin. Most of my Bitcoin is owned in the form of pure Bitcoin, that is in a brain wallet, and that's mostly because in the early days there was no other way to access Bitcoin. You had to learn how to do it in a brain wallet. Today you don't, and the more recent Bitcoin that I've bought, and I bought Bitcoin yesterday. I bought some Bitcoin on the dip, at 69,000. I thought it was a good price, because I think this asset is going much higher than 69,000, much higher. Especially the halving is coming up in April. So theoretically, the halving, if the demand doesn't stop, the theoretical result of a halving is a doubling. That's what it is. And MicroStrategy, I believe, is a wonderful way to hold the Bitcoin, because you have Michael Saylor, who's always ready to short fiat and borrow money in fiat. You short it, and you take that money and you buy Bitcoin. That's one of the big advantages of MicroStrategy versus pure Bitcoin, is that MicroStrategy, you play on both ends of the equation. Not only do you buy more Bitcoin, and since you buy more Bitcoin, you're going to make money like that, right? It's a rare asset, but you also short the US dollar. And shorting the US dollar is what, for example, real estate companies have always done, right? The concept of a REIT, most of the return of a REIT comes from the shorting of the US dollar, right? Real estate barely grows. We barely build any more real estate each year after year, but then the US dollar gets dropped. So that's the rationale, in my view, for investing in REITs, for example, which I don't. I think real estate creates lousy returns, especially compared to technology today and disruption today. Happy to own MicroStrategy. I have increased my position in miners recently. Now, of course, CleanSpark, I was buying CleanSpark in $2 to $3. And I bought some more at higher prices too, right? $8, $9, etc. But it's tough to add to CleanSpark right now at 17, even though I think I probably should. But it's tough to do that because you remember buying it much cheaper. But I've added two other positions. One is Riot blockchain, but I stopped adding to Riot blockchain because I didn't like that they did not hold a conference call last quarter. They did in Q1. Like, why do you not hold a conference call? That's fishy. So I didn't like that, and that's why I still hold my position. I'm happy to own it, but they didn't hold a conference call. And I recently added to Bitfarms. I'm very positive about Bitfarms, especially about their new mines in Chile and in Argentina, and some of the partnerships that they are doing. Bitfarms also is a Canadian company, which I think is interesting from a miner standpoint, because one of my fears is that you may have seen in the Senate they're trying to introduce this Bitcoin mining tax, this 30% Bitcoin mining tax, and I fear there is going to be a lot of attacks against Bitcoin miners in the upcoming election in the United States. And of course, Bitfarms will be protected from these attacks because they operate in Canada. So that's good protection from these attacks, even though if you listen to the Bitfarms call, you may know that they have their own issues in Canada. They have a 15% tax on electricity, which they're arguing with the Quebec government to figure out whether they're eligible or not. Anyways, I like Bitfarms right now. Right now, as far as my miner buys, I'm focusing on Bitfarms. Keeping in mind that miners and CleanSpark for me, for example, is a very old position. Actually, I bought this stock a while back. Back in the prior bull market. I don't intend to sell out on my Bitcoin miners. These are miners that I own for a long run, and so when I look at these miners, I don't think they're going to be those that are going to be acquired. Some miners may get acquired, but I don't think that they're going to be those miners who get acquired by others. Of course, and that's a caveat, if Bitcoin gets to 150,000 near halving, like let's say like a month after halving, Bitcoin gets to 150 grand or something like that, I don't think no miners getting acquired. I think miners are all going to survive and they're all going to make it if Bitcoin is at 150. So it all depends what the price of Bitcoin is. These are the safer miners because they have all great orders of new rigs and options to buy more rigs, right, that they bought in the bear market. And so they've been wise, in my view. Coinbase, I still own all of my Coinbase. I'm up more than 200% on Coinbase. I remember buying Coinbase in the low double digits. And of course, because, that's how the market thinks. Crypto's dead forever. And so they drop the stock to nothing. And now they realize, oh, well, wait a minute, crypto's maybe not that dead. Coinbase is the leading custodian of all of these Bitcoin ETFs. Think about the fees that Coinbase is going to make. Coinbase owns half of USDC, right? One of the leading stable coin. Coinbase has its hands in everything. And if the internet is slowly getting replaced by crypto, if companies compete with algorithms, and those algorithms are run by cryptos, which is where I think we're headed, a lot of companies are going to be replaced by blockchains. Especially in the software space. Think about the number of software companies that you really don't need anymore because you can just replace them by a blockchain. I think this is going to be one of the great debates of the next 20 years is what companies can be replaced by a blockchain. Well, companies that have a lot of tangible physical operations, they're going to have a hard time getting replaced by a blockchain. But companies that are fully digital, I think you can make an argument many of them are going to be threatened by Web 3.0. Web 3.0 is literally algorithms competing against legacy Web 2.0 or like traditional companies running Web 2.0 website, right? And it will go at some point beyond the financial industry. I really believe that because there's no need for companies anymore if you can just have crypto, and this is going to get even more as we get algorithms writing code and AI is writing code and writing entertainment. And Coinbase is at the heart of that. So Coinbase is a very long-term hold for me. It's really a call option on this future. And some of you have asked in the comment section if I own any other cryptos and or if I'm a Bitcoin maxi. Well, I'm mostly a Bitcoin maxi, I suppose. I'm like 98% Bitcoin as far as my pure Bitcoin goes. But I do have a teeny tiny bit of ETH and an equal size tiny bit of Solana, Sol, and I have a little bit more of Dogecoin. Actually, believe it or not, I bought Dogecoin when it was fractions of a penny, when it was like 1/20th of a penny. And I saw it rise to 69 cents a penny or 69 cents a Dogecoin or something like that. And I saw it come back down and I saw it rise again. And I've never sold it and I'll never ever sell it because that's what crypto teaches you. If crypto teaches you one thing, it's to never ever sell. And let me conclude this by quoting Michael Saylor's recent interview on Bloomberg, which is people that store their wealth in fiat, we have a name for them. We call them poor. Think about that. People that store their wealth in fiat, we have a name for them. We call them poor. And that is what happens when you sell an asset for fiat. When you sell an asset for dollars, that's what happens. And, and that's why bonds, in my view, bonds are gone. Because bonds, it is what it is. Bonds, you're saving in fiat. That's what it is. Bonds is a contract to get your fiat back 10 years from now, or 20 years, 30 years from now. When you're storing money in bonds, you're storing it in fiat. And so that's why I don't believe in the 60-40 portfolio. And right now my portfolio is like I said, number one position is Bitcoin. Not by choice. It's not a choice. It just happened to be this way. It's like, it's not by choice, right? Because assets grow. And Tesla, by the way, is not by choice either at this top position. I've added a lot of Tesla at higher prices, but I had quite a few Tesla at much lower prices too. So anyways, and that's just the way assets work. And eventually you kind of lose track of your cost basis and how much money you initially put in eventually, especially as you don't sell. And I hide it on my broker, so I don't really see the long-term payments, long-term returns. Anyways, I am done with this video. I hope you found it helpful. This is no investment advice, no financial advice. It's just entertainment. Hoping you were entertained. Please like, please subscribe. Thank you so much for watching, and have a wonderful day.